Joining us right now is Carol Schleif. She is Chief Market Strategist at BMO Private Wealth. And Carol, it's been a big week for earnings. We've got a pretty rocky backdrop. What do you think about where things stand? I know you're somebody who looks at this, and over the course of the year, you anticipate that stocks will continue to climb.
Yeah, first off, thanks for having me and happy Friday. And yeah, earnings have come in pretty well, if you will. I mean, there's a lot of other political wins, if you will, aimed at the banks and the financial services industry in general. But pulling through on some of the themes, the consumer stays resilient. Their balance sheets remain in pretty good shape. Companies in general are remaining resilient. And at least looking at the markets, you had a lot of the veggies first, if you will, in terms of tariffs and all the news early in last year. And we had to get a lot of the dessert coming at the end of the year, where you had some of the implications of the big, beautiful tax bill for both corporations and consumers coming through. You've got deregulation going on, which in particular is really helping the banks and aspects there. So there's a lot of things teed up to really be supportive of earnings, because it's important to remember, while markets advanced last year, so did earnings. And we'll see a lot more over the next couple of weeks how earnings come in. But we anticipate the attention that our companies have paid to really cranking down on their margins, or being very attentive to maintaining those margins, should really come through in terms of amplified bottom line growth in aggregate.
Carol, when you're talking about the pressures that have been brought up against the banks and the financials this week, you mean basically the president's call for a cap on credit card interest rates that they can charge consumers?
Yeah, there's that piece of it. Although you've seen a lot of the banks, I would imagine what they'll do is they'll probably try to get together and figure out how can they take a step towards something that benefits the consumers, if you will, because it's pretty tough if you're a bank to come in reporting record trading revenues, record M&A revenues, and record revenues in a lot of other parts of the bank, and then insist that you can't necessarily give somewhere on credit card rates or the things that consumers are doing. So I would imagine there'll be some sort of a lot of conversation around that, about how do we preserve margins and growth and things that way, and still move forward towards being more attentive to the rates we're charging consumers.
If those were to go through, there have been some concerns that, or at least the bankers themselves have said, they're just not going to lend money. They're not going to allow credit cards to be taken out by consumers. I spoke with Brian Moynihan from Bank of America the other day. He said anybody who's not well into the 700s in their credit score wouldn't have access to credit cards. Is that a broader concern for the economy, or do you think that this is just not going to happen?
Well, I think it is a concern for the economy, but it's also important to remember that it's those top-end consumers that are doing something like half of the consumption, which relates to about 1/3 of GDP, comes from that top 10%. And that top 10% tends not to revolve their credit. So, and a lot of the reason they're spending relates more to where their asset values have gone, if you will, than where their employment is. So that piece of it in aggregate is probably pretty steady, but it is the other tiers, the other 80 or 90%, if you will, that do revolve, and there's issues there. And there'll be issues most likely if that continues. If you tighten up credit there, either you shift some of it to the buy now, pay later industry, or the access to purchasing and stuff dries up. So there's concern among some of the consumer companies from that perspective, especially those that are more heavily weighted towards those segments.
Carol, the reason, though, you think that the market could get to 7,700, I realize you don't publish those numbers, but you're suggesting 7,700 for the S&P 500 is just that earnings is really what takes over?
Yeah, because, I mean, 7,700 would be roughly 10, 12% up from where you ended last year, and we expect earnings to grow that much. So even because we aren't expecting valuations to expand, if anything, we think there might be some pressure there. But we also think that in aggregate, you'll be able to generate good growth with less inflation this year.